Hello, I'm Kevin Duignan, Global Head of Financial Institutions at Fitch. Today we'll discuss the key challenges and latest trends of Asia-Pacific banks. Joining me is John Cornish, Head of APAC Banks, Sabine Bauer, who leads our Hong Kong and Japanese bank ratings, and Grace Wu, who leads our Chinese bank ratings. Hi, John, how are you?
Good, thanks, Kevin.
Let's talk about our outlook for APAC banks to start.
Well, of the 17 markets that we cover in the region here, all of them have stable rating outlooks, and that reflects generally the benign operating environment or the magnitude of buffers that have been built up or the outlooks of the supporting entities, and that could be either the sovereign or institutional support. And just over 50% of the IDRs are underpinned by the viability ratings, meaning that there's a very significant amount of ratings that do factor in support. And in Asia, there is very high expectations of government support.
And what do you see as the major risks and sensitivities for the banks in the region?
Well, aside from the ratings of the supporting entities, in terms of the intrinsic credit profiles, the banks have generally got pretty decent buffers that have been built up over a while. But there are some exceptions. So we see that, for instance, in India and Vietnam, Mongolia, and China, so all emerging markets indeed. But we're generally seeing them try to address that through raising of additional capital, and that is happening as well.
And how well positioned do you think the banks are in the region for these sort of challenges?
Well, the banks have generally built up pretty decent loss absorption buffers, but that said, profitability continues to be under pressure, and the banks have been pushing to raise additional capital. So we're seeing that in certain cases. Again, for example, infusions of capital into the Indian government banks and also the Chinese banks raising capital through private placements as well.
And around the globe, we've seen the issue of governance result in some rating actions. How are you guys dealing with that in terms of considering in our analysis for APAC banks?
We do factor them into our ratings, into the VRs. But that said, even though governance can be a drag in terms of the credit profiles, especially amongst the emerging market banks where you have higher government influence, etc., generally, governance is not as much of a constraint as the operating environment is. But that said, we certainly have taken some rating actions in the first half of this year through either weaknesses in terms of governance or bank conduct or risk controls. And examples of that would be in India and even in Australia.
Thanks, John. Let's turn to Sabine. Sabine, the market has been questioning whether regulation will have an impact on strategies for U.S. and European banks. What are you seeing in terms of the potential impacts on the APAC front?
We will certainly see changes in business strategies, but I think it will not be very fast and not in the near term. It will be a gradual evolvement of the strategies, both I think from a regulatory point of view when it comes to technologies and licensing of new banks, applying that aspect, but I think it would also be more towards the competitive environment and how the regulators treat the non-bank financial institutions that also are a force here in Asia.
John mentioned earlier that there's 17 jurisdictions covered in the APAC region. What are you seeing in terms of differences in the regulatory and legal framework sort of from one end to the other of those 17 regions?
There's a big spectrum, indeed, 17 markets, developed and emerging markets. On the one hand side, we are seeing Australia, Singapore, and also Hong Kong being very established regulators and having a good track record in also applying macroprudential measures. On the other hand of the scale, we see the frontier markets, Mongolia, Sri Lanka, Vietnam. They are challenged by a couple of developments in their economy, so it's more volatile, and the regulators often find it very difficult to enforce the policy tools that they have on hand. I think macroprudential measures is very important there, and that's a theme across Asia at the moment, that the macroprudential measures are shaping the economic environments and also our view of the regulatory and legal frameworks.
We see regulation used to cool property markets, for example. What are you seeing in APAC? Are you seeing macroprudential type of measures, or are there other methods that the regulators are using to address market imbalances?
Macroprudential measures are really, really popular, and I think they help the regulators just to be very tactical about certain things. It could be the supervisory authorities, but it could also be monetary policymakers that use that type of measures. And it ranges from very established LTV regulations, or even in some markets, loan growth targets, or limiting of concentration risk with regards to ratios to equity. It's a broad range, or even reserve requirements on deposits. We would account for that as well.
We've done quite a bit of research on foreign banks' exposure to mainland China. What are you seeing in terms of developments on that front?
It's growing, and it's just not stopping. So I think there's a very strong underlying trend that businesses abroad want to do more with Chinese companies, Chinese banks. So we're seeing that flow of financing into China. At the same time, we are also seeing the Chinese corporates, Chinese entities going abroad. And that also then ends up most of the time in Hong Kong, because that's the closest capital market where the entities can get US dollar funding. So we see a very steady development. When it comes to the composition of the China exposures, what we are seeing is that a lot of the lending still remains with state-owned enterprises. At the same time, that share has declined. You really have to look at bank by bank. If you look at the system average, that's really a difficult measure, because Hong Kong is dominated by a couple of large banks, and then that system average is not representative.
Hong Kong banks obviously have the most significant exposure to mainland China, but also the longest history. Have they learned lessons from that experience, and do we consider that in our rating analysis?
It's a bit of both. They have learned lessons just because they've been lending to China for many, many years. At the same time, I think also there's new risks evolving, and those need to be constantly assessed. And I think that's what the Hong Kong banks are doing and what the regulators are doing, yet evaluating the risk appetite for the Hong Kong banks is, for us, the key when we look at our credit ratings for the Hong Kong banks. But just on one or two examples on where the Hong Kong banks have learned lessons, actually when they started lending, a lot of it has been without real genuine economic reasons. So there's a lot of arbitraging going on, or used to be going on. At the same time, also a lot of lending to the SMEs without proper access to collateral. And fraud cases, of course, have also haunted the Hong Kong banks. So I think the big lesson learned is that the Hong Kong banks want to understand what they're financing, who they're actually lending to, and where the collateral sits.
Let's turn to Grace with some questions on the Chinese bank sector. Grace, since early 2017, the authorities in China have introduced a variety of regulations aimed at deleveraging. We're seeing actually a number of onshore defaults, though, this year, but banks are mainly reporting improving or stable asset quality. How do we reconcile those two?
Even though there's been an increased number of onshore bond defaults this year, if we look at the aggregate amount, so far in the first half, there's about $1.5 billion that has defaulted. But that's against the domestic corporate bond market in China of roughly $2.4 trillion. So really the amount of defaults is very insignificant compared to the size of the market, and it's difficult to make any meaningful conclusion just from those numbers alone. And partly the banks' reported asset quality ratios are supported by ongoing efforts to resolve NPLs, such as increased NPL write-offs and also disposal to asset management companies. So all these efforts have worked towards maintaining the reported ratio at about 1.7%.
The crackdown on shadow banking has affected asset growth at banks. What are we seeing in terms of deleveraging trends?
I would say that there are clear signs of deceleration in credit growth in China, especially towards non-loan credit and also lending to traditionally higher risk industries as well as shadow activities. But if we look at the overall debt leverage, that hasn't come down. So I wouldn't say that we're in a real deleverage cycle right now. But that said, the crackdown on shadow banking has resulted in a sharp decline in terms of asset growth for some mid-sized commercial banks. But looking at the overall credit to GDP numbers, our expectation is that these would still be on a rising trend, although the increase is much milder than what we have observed in prior years. And it's also uncertain to us whether the regulatory commitment towards deleveraging would be sustained if growth in China were to fall below the authorities' targets.
The PBOC has reduced the reserve requirement ratio 3 times this year, which is normally associated with a loosening policy environment. Does that suggest that the Chinese monetary policy is loosening again?
For the moment, we would regard these RRR reductions as a means of managing system liquidity. The crackdown on shadow activities have tightened interbank conditions, and as a result of that, the funding cost for a lot of the smaller banks which have weaker deposit franchise and are more reliant on these type of market fundings, they have suffered at the expense of poor profitability. So for the time being, we don't see it as a clear sign of loosening, given that the message at the macro level is still very aimed towards maintaining overall system leverage. But that is a risk. Certainly, if we see risk were to further build up within China, and that leads to further economic imbalances, then that would be potentially negative to China.
Fitch has had some upgrades recently of the standalone viability ratings of certain Chinese banks. What's driving that, and what would change your sector outlook for Chinese banks?
We have recently upgraded the standalone viability ratings for China Construction Bank, Industrial and Commercial Bank of China, and Bank of China to BB+ from BB. But the upgrade in these banks' viability ratings is more driven by their own intrinsic profile, whether it's consistently high capital buffers compared to other Chinese banks, or in the case of Bank of China, the level of geographical diversification. For the time being, we have maintained our negative operating environment outlook for China, given the ongoing challenges. But if we were to get more evidence that the authorities would indeed place financial reform over growth targets, then that would give us more assurance or greater confidence that these deleveraging efforts will be sustained. And if the leveraging is successful and it results in a reduction in contagion risk for the system, then we would be prepared to revisit our view on China's operating outlook. Here at Fitch, we're always trying to find better ways to distinguish the credit profile for individual banks. And a lot of that is done through our ratings work to look at how individual banks cope with China's challenging operating environment.
Thanks very much for your insight, Grace. And Sabine, thank you, and John for your contributions. And thank you for watching. We hope you enjoyed this roundtable discussion.